Reason number two is if you've done a little bit more homework and you know what you bought and why you bought it. So the second reason is the investment case for the company you invested in changes. And so if you've done your research, so you're the reformed version of Patrick, you've spent 10, 20 hours looking into a company, you've investigated their management team, you know what products and services they sell. Maybe you've even looked at the competitors and the reviews online, and you've compiled all your research and you're pretty confident with what you invested in. But as companies, companies change. And so over the years, the company might have changed direction, made a different acquisition. It might be selling new products. It might have discontinued the products that you were the reason why you invested it in the first place. The company might have gone to court over certain issues. There might be new CEOs. There might be new good or bad press that's come out. And not all these changes are going to be positive for the company, or positive in your opinion for the company. And sometimes they might mean you don't want to invest in that company anymore. And that's why it's really good to have that research written down, because you can come back to it. If the company makes an announcement or bad press comes out, you can make a really informed decision when the company might make some changes.
Yeah. And this is what we call an investment thesis, right? So this is all about writing your notes down. So you will remember countless times when we did Shares Month in 2021, we talked about this as well then. We've shared our investment checklist, a very simple investment like framework. You can find it on rask.com.au/philosophy. And although our checklist as analysts is like multiple pages, we've got about 45 questions on there that we have to answer before we can even begin researching. That's how comprehensive it is. For these 5 things, you can just focus on these 5 things if you do a miniature write-up. So what I would say is whenever you buy something, write down what the company does, who the management team is, what's the long-term kind of like growth outlook, why is this company stronger than competitors, and if you can, just outline the reasons that you might sell. Those are some very simple questions. If you write them down in advance, you're going to be a much better investor over the long term, because you're going to reflect on the reasons that you bought or sold something, and you've got something as a basis to work forward to. So like, for example, we had a company, I'll give you an example of how this goes right and wrong. There's a company called Bubs Australia. BUB is the ticker code in the Australian market. Bubs creates infant formula and goat's milk. We thought it was a really strong brand here in Australia. We thought the potential for the business in China was also really compelling, because goat's milk was a growing market in China. But then obviously we had the trade war between China and the USA, China and Australia and the USA. And then we also, the business here in Australia started to falter because people weren't buying it from Chemist Warehouse and shipping it overseas. So our investment case, our investment thesis was broken. And subsequently, we actually did pretty well from that because we avoided it falling further. But I'll give you another example. We invested in a company called The Trade Desk from the US. It's a company that does advertising for websites and for ad agencies. And during COVID, I was really worried that the business was no longer going to get advertising revenue because everyone was scared about spending money. So we sold it because it didn't align with our thesis of it capturing more of the advertising dollars. Turns out it went completely the other way, and it got more and more and more. And the company went up about 5 times in about 6 months. But just having that thesis, we could reflect back on it and be like, okay, why did we own The Trade Desk? Why did we own Bubs? Okay, that's no longer the reason that we still own it. So very good reason to break.
And the reason you buy a share and your investment case might look completely different to someone else's reasons. So something might change about the company, and your friend who owns these shares might be completely fine with holding on, but because of your investment case and the reasons why you want to own it and why you wouldn't want to own it, you might decide to sell. So it's really personal, and that's why it's good to do the research and kind of work out what your own framework and rules for selling are.
Yeah, Professor Richard Feynman, I believe this is the best use of this technique. It's called the Feynman technique. You explain it to someone else. So you explain your investment thesis if you've got those 5 things on your piece of paper. We use Notion, by the way. So we put all of our investment research into Notion. It's free if you're just signing up on a single use plan. And then we write the 5 things down, and then we'll explain it to the team, and the team can poke holes in it. We go back to the drawing board, do more research, and then we explain it to the team again. If there are more holes, then we go back again, and you do that process until the very end, and then you simplify it. So it's called the Feynman technique. Learn, learn by research, explain it to someone else, go back to the drawing board, and at the very end, simplify it down to its very most basic reasons for owning the investment. Fantastic, powerful. I don't know did you use the example of someone?
No, I haven't.
Okay.
Okay, so let's say there's an investor called Natasha who spent 20 hours researching company Bravo, I'm just making up a name here, a few years ago, before deciding to invest $5,000 in it. So she's feeling pretty confident. However, a few years later, the company made an acquisition that Natasha didn't think aligned with the business anymore, and it didn't really fit within her reasons for owning it. So after reviewing her initial research notes and learning more about the current situation and really taking a good look at everything holistically, she decided to sell her shares in company Bravo.
That's great. So I can hand over heart say that this is the most powerful thing for investors in individual shares. You can even do this for ETFs. You can do it for anything that you do in your life, basically. But for individual shares, this is powerful. Writing down your reasons for buying something is incredibly, incredibly powerful. It will make you sleep easier at night. It will help you understand when things go bad, why you got into that situation. And generally, it will just improve your understanding of investing, out of sight and out of mind. So please go ahead and do this. If you need any examples, just reach out to us. Use Facebook or Twitter, and we can point you in the directions of some of our checklists. Don't forget, we've got our shares for beginners courses and all that sort of stuff on the Rask websites. So they will provide ways to do this as well.
And that even reminds me of our episode we did last year on making better decisions, after I was inspired by reading Annie Duke's book, How to Decide, because we don't really learn it in school about many things, but also making really good decisions and actually having a framework and a process around that. And I think this can apply to all areas of life, and whether it's a career decision or a financial decision, having a process you go through, whatever works for you, but even just writing a few of the reasons why you made that decision and not another decision down is really helpful. And especially if you decide not to make a decision, if you're like, I'm just going to hold this company for another year, see what happens, you should write down the reasons why you did that, because by not making a decision on whether you want to hold it or sell it and just sort of leaving it, that is a decision. So I think that's important to acknowledge as well.
Yeah, so that you reminded me of three things here. I'm going to be as quick and concise as I can. So there's a thing in Annie Duke's book called resulting, which is where you judge the decision that you've made, the quality of your decision based on the result. A lot of investors buy shares, particularly in that first instance where they buy things they don't know why. It goes up and they think, hey, pretty good.
I've got this down.
I've got this. Do exactly the same thing next time. So I'll give you an example close to home, and this is not to butter my own bread. It's a massive lesson in humility. When I was starting out investing, I invested about $2,500, I think it was, in a company because I paid for a subscription for this website, which gave out broker research. So you could go in, you could see what the brokers were researching and recommending. The company went, the value of my investment went to about $22,000. I think I've written about this online. You'll be able to find it. $22,000 in about a year. So it was like huge, huge opportunity. And then at the end of it, I was like, okay, genius. What my strategy was I'd go into the broker website and pick the company that the brokers were most bullish on and buy it. And so that's what I did. I then just recycled that strategy. Like, hey, I win. This works. But then this is me going up that humility curve, up the complexity as well. Losing my humility as I went up complexity. And then I started to take that money and I invested in really complex things that I didn't understand on this basis that I thought it worked. And I lost basically everything that I had invested before and came right back down that complexity/humility curve. And now I just keep it simple. That's the first thing. Just one other thing, just to improve your knowledge of business and investing. Over the weekend, Warren Buffett came out with his annual letter. It's on the Berkshire Hathaway website. It's totally free to download. You should get it. He's the greatest investor that ever lived. And his partner in crime, Charlie Munger, has this idea that he calls it the orangutan effect. He said, when you make an investment, basically, you should tell a bunch of orangutans what you're investing in and why. And he said, at the end of the day, the orangutan will have no idea what you're talking about, but you will understand it better because you've at least spoken about it and you will realize the flaws in your strategy. And so, you just remind me of those two things.